Several of you have been asking the same question in the comments this week. A tanker was struck by projectiles in the Strait of Hormuz on Monday. Iran set a UAE oil port ablaze. Brent crude jumped more than 5% in a single session. US manufacturers reported their worst cost inflation reading in 4 years, and gold fell. Gold went down. During an active war, during a major escalation, during the worst inflation reading since April 2022. If that seems contradictory, it is not. And understanding exactly why it happened is the single most important thing a stacker can know about this market right now. This is Go Finance. Let me start with exactly where gold stands today, because precision matters. Gold is trading at approximately $4,119 as of May 5th, 2026, up 0.83% from the previous day. Over the past month, the price has fallen nearly 2%, but it is still 34% higher than a year ago. Gold hit an all-time high of $5,405 in January 2026. It is now down approximately 16% from that peak. Gold remains down nearly 15% since the Iran war began in late February. Now here is the event that should have sent gold higher, but did not. Iran hit several ships in the Strait of Hormuz and set a UAE oil port ablaze, as President Trump's attempt to use the US Navy to free up shipping provoked the war's biggest escalation since a ceasefire was declared 4 weeks ago. The US dollar firmed and Brent prices jumped more than 5%, and gold fell 2%. Spot gold dropped 2.4% to $4,570 per ounce, its lowest since April 2nd. Peter Grant, Vice President and Senior Metal Strategist at Zena Metals, explained it directly. The Trump administration rejected Iran's most recent offer, and so the strait remains closed. That has driven oil prices up and revived concerns about inflation heading into the FOMC meeting, pushing gold to 4-week lows. That is the paradox, and here is the mechanism that resolves it. Gold is a non-yielding asset. It pays no interest, no dividend, no coupon. The cost of holding gold instead of a treasury bond is called the opportunity cost. When the Iran war sends oil higher, it sends inflation higher. When inflation goes higher, the Fed cannot cut rates. When the Fed cannot cut rates, the opportunity cost of holding gold stays elevated. When the opportunity cost stays elevated, paper traders flush their leverage positions, and the price falls. The same war that should be sending gold up as a safe haven is simultaneously keeping rates elevated through the inflation channel, which pushes gold down through the opportunity cost channel. Both forces are real. Right now, the rate channel is winning. The Fed is structurally trapped. It cannot raise rates into a contracting labor market or cut rates into 84.6 ISM prices paid and 3.5% PCE. Last week, the Fed left rates unchanged in its most divided decision since 1992 on deepening concerns about higher energy prices percolating through the economy. Barclays joined a growing list of brokerages to bet on no policy easing from the US Federal Reserve this year. Pricing suggests that ongoing inflation due to the Iran conflict complicates the Federal Reserve's ability to implement rate cuts in 2026. The probability of an early rate cut by the June 2026 meeting remains low, reflecting concerns over inflationary pressures and economic growth forecasts. Now let me show you what the Federal Reserve Bank of Dallas documented about the inflation picture, because this is the data most people are not seeing. The outbreak of the Iran war in late February 2026 disrupted oil and refined product exports from the Middle East. This has been reflected in a global surge in crude oil and retail gasoline prices with no end in sight. The sharp increase in the WTI price causes headline inflation to rise by 1.7 percentage points at an annualized rate in Q1 2026. Headline inflation remains elevated through Q3 2026. The IMF has decreased global growth forecasts by 0.2 percentage points and raised inflation projections by 0.6 percentage points for 2026. The Federal Reserve has projected inflation could rise to 5.4 to 6% if the war persists. The 2026 Iran war, including the closure of the Strait of Hormuz, has led to what the International Energy Agency has characterized as the largest supply disruption in the history of the global oil market. The conflict has echoed the 1970s energy crisis through acute supply shortages, currency volatility, inflation, and heightened risks of stagflation and recession. The 1970s energy crisis. That comparison is not dramatic language. That is a documented historical parallel being drawn by the International Energy Agency itself. And the 1970s is the single decade in modern history when gold performed best. From 1970 to 1980, gold rose from $35 per ounce to $850, a 2,300% move. Precisely because stagflation destroyed the purchasing power of every dollar-denominated asset, while gold preserved wealth in real terms. UK inflation is expected to breach 5% in 2026, the highest prediction for Europe. The OECD forecasts that due to the war, inflation in the US will be 4.2% this year, higher by 1.2% than previous predictions. Europe is facing elevated risks of falling into a recession. Germany, the United Kingdom, and Italy were at the highest risk of recession. That is not a localized Middle East problem. That is a global stagflation event in real time, and the gold market is caught between two forces, the structural bull case getting stronger every day, and the short-term rate headwind keeping paper prices suppressed. The question every stacker needs to answer is which force wins, and the data gives a very clear answer. Here is what the structural data says while the paper price is falling. World Gold Council Q1 2026 demand data released this week is unambiguous. Total Q1 gold demand, including OTC, was 2% higher year over year at 1,231 tons. Bar and coin demand of 474 tons was the second highest quarter on record. Asian investors led the charge, buying up gold investment products. Central banks bought 244 tons, up 3% year over year. The LBMA gold price set a new quarterly average record of $4,273 per ounce. The total value of quarterly demand hit a record $193 billion. 74% higher than the same quarter 1 year ago. Investment in gold bars and coins surged by a massive 42% to 474 tons, the second highest figure on record, driven by Asian countries like China and India. Poland and Uzbekistan led central bank buying as emerging market institutions continue to diversify their reserves in response to geopolitical fragmentation and de-dollarization of international trade. The paper price is falling. The physical demand is setting records. That gap does not close by the physical market coming down. It closes by the paper market eventually reconnecting with the reality that the physical market has been pricing all along. Now here is the development this week that almost nobody is covering in the context of gold. The United Arab Emirates announced that it would leave OPEC and OPEC+. The UAE quitting OPEC is not a minor headline. It signals that the Gulf Cooperation Council economic model, built on collective energy pricing and coordinated production, is fracturing under the pressure of the Iran war. When the most stable and economically diversified Gulf state decides it can no longer operate within the OPEC framework, it tells you the geopolitical architecture of the Middle East is undergoing a structural realignment. And structural realignments of that scale are exactly the environment that drives long-term central bank gold accumulation, because every government watching this is reassessing what a stable reserve asset looks like in a world where the old order is breaking down. Now let me address the Fed meeting directly, because this week is critical. Investors expect the Fed to hold interest rates steady at their current 3.50% to 3.75% level. They will also closely listen to Fed Chair Jerome Powell's remarks at his final press conference before handing the central bank over to his likely successor, Kevin Warsh. This is Powell's last press conference as Fed Chair. Warsh takes over shortly, and Warsh has a documented preference for tighter financial conditions and a more aggressive reduction of the Fed's balance sheet. The incoming Fed Chair wants to change how inflation is measured. That single shift from core PCE to trimmed mean could reopen the path to rate cuts and compress the real yields that drive gold. That is the hidden catalyst nobody is talking about. If Warsh changes the inflation measurement framework, and that change opens the door to rate cuts, even in a high-energy price environment, the ETF re-entry wave that Goldman Sachs has documented, 60 tons of new demand per 25 basis point cut, arrives on top of the central bank's structural floor. That is the trigger that closes the gap between the paper price and the structural reality. Goldman Sachs holds its year-end 2026 gold target at $5,400 per ounce, with the thesis that once this paralysis becomes consensus, real yields compress and gold re-accelerates. Gold is trading at $4,648 per ounce, up 41% from a year ago, down 14% from January's record. Both numbers are true. The one that matters is the 41%. It held through a war, 3 hawkish Fed holds, and the most fractured FOMC vote since 1992. That framing is exactly right. The correction looks large when you measure it from the January peak. It looks like confirmation of a structural bull market when you measure it from a year ago. Which measurement you use depends on whether you are a paper trader operating on a 48-hour window or a stacker operating on a 3 to 5 year horizon. Now let me give you the honest picture of what actually breaks this correction. There are 4 specific catalysts that reverse the current headwind simultaneously. First, a ceasefire or diplomatic breakthrough in the Middle East that normalizes Strait of Hormuz traffic. Oil falls, inflation eases, rate cut expectations return, ETF demand re-enters. The ceasefire scenario, which leads to oil normalization, CPI relief and Fed rate cuts, targets the $5,400 to $6,300 range for gold by year-end, according to Goldman Sachs modeling. Second, a Fed rate cut regardless of the geopolitical situation. Goldman Sachs documented that each 25 basis point cut generates approximately 60 tons of new ETF gold demand within 6 months. With $559 billion in gold, ETF assets under management positioned and waiting, the first cut triggers a demand wave. Third, the Warsh inflation measurement change. If the new Fed chair shifts from core PCE to trimmed mean, it potentially reopens the rate cut path even with oil above $100. That is a policy catalyst that the market is not pricing at all. Fourth and most powerful, the structural reality simply reasserts itself through the physical market. Geopolitics remain front and center in our outlook for gold demand in 2026. Our view remains that investment and central bank demand will be supported by ongoing geopolitical risk, with further investment impetus from elevated inflation and persistent high gold prices. We are stackers here. We understand what this market is telling us. The paper price fell while a tanker was attacked because the rate mechanism overwhelmed the safe haven mechanism in the short term. But the physical market set an all-time quarterly demand record at the same time. The paper price and the physical reality are telling 2 completely different stories, and they cannot both be right forever. The 1970s stagflation parallel that the IEA itself is drawing is not a bearish signal for gold. It is the most historically documented bullish signal that exists. The Fed's most divided vote since 1992 is not a sign of policy confidence. It is a sign of institutional paralysis in the face of forces that the current monetary toolkit was not designed to handle. And the UAE quitting OPEC is not a minor OPEC story. It is a signal that the geopolitical architecture that has structured global energy markets for 50 years is fracturing in real time. All of that is happening while gold holds 34% above where it was a year ago, while central banks set quarterly demand records, while serious institutional money accumulates physical metal at prices the paper market calls oversold. The correction is real. The structural bull market is more real, and the gap between them is where the opportunity lives. Drop a comment below. Where are you watching from, and does this correction feel like an opportunity or a warning sign to you? I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines, just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe, turn on notifications. Data before price. The Vault Keeper.